when we have a client who's going into a home purchase, I tell them make sure your debt to income ratio is as low as possible. I tell them make sure your credit score is as high as possible, and then their income is what it is. There's an added layer when you're talking about starting or buying a business. Can you talk about the personal finance profile that they need to have? And then also, what does the business have to look like to be approved?
That is a great question because I often get this. I have people that call that want, similar to the mortgage side, they want to get a pre-qualification for them as a potential SBA buyer. And so there's two different profiles, like you said. So personally, you need to make sure that you have your personal house in order. So similar to the same things that Brenton, you coach about when going to buy a house, you want to make sure that your credit score is high, that your debt to income ratio, we still like to see that at 50% or less. Credit scores do play into this. We typically like to see 650 or above. However, I do tell people we get a lot of, young individuals that maybe haven't built credit yet. So if it's an issue where you just haven't built credit, so you don't have credit on your credit report, don't let that necessarily be a barrier to applying for an SBA loan. Now, if your credit score does have late pays and stuff on that, that is something you would want to get cleaned up ahead of time, because that's going to be a big red flag to any lender of if you historically haven't paid your loans on time. That's a really good indication that you're probably not going to pay future obligations on time. The other thing you want to be ready for is if you are doing a business purchase and you're going to need a down payment, having those funds readily available as well. So making sure that you have some what we call personal liquidity, personal cash that you can actually come up with that down payment. That's going to be really important for you to when you apply for your SBA loan. On the flip side, with the business, the SBA only lends money to a business. You're personally guaranteeing it, but the bulk of the SBA loan approval is going to be based on the cash flow of that business. So if you are buying an existing company, the loan amount is going to be 100% dependent upon the last 3 years of tax returns for that company that you're looking to buy. You as the buyer is important that you, one, have a good credit score, you have good industry experience, and you can come up with whatever the needed down payment's going to be. But at the end of the day, if the cash flow from the company that you're looking to buy cannot support the loan, it doesn't matter how strong you are as a buyer. So both of the sides of the table play an equal role in getting approved for an SBA loan. Same thing if it's an existing business. If it's an existing business and let's say you're coming to apply for an expansion loan, we want to see that the company is at least covering their debts today at a 1-to-1 cash flow ratio. So if the business is struggling and you're thinking that maybe going and expanding or buying a competitor can kind of help the business be more successful, we're going to say, no, we don't need you to take on more debt if your company isn't currently breaking even and covering all of its expenses. We really need to dig into the fundamentals of your business and figure out why it's not profitable before trying to go and take on more debt. Then we have the instance of a startup, and a startup doesn't have tax returns, existing cash flow, anything like that. So when we are looking to do a startup loan, and this is one of the misconceptions out there from the SBA marketing that seems to be out there, is that SBA is a great tool to fund a startup. Yes and no. So the SBA still tells us that we need to have a revenue source, a cash flow stream that is not projections that can repay the loan. So if you're coming to us for a startup loan, you need to have some sort of outside secondary income that can help cover those payments while the business is getting profitable. And you talked about this on your last podcast, that in a startup scenario, whether you're buying a franchise and starting up or starting a brand new concept, there's going to be a 6 to 12 month period there where you're spending money and not generating the revenue to cover that. So you've got to have some sort of outside income to be able to cover that in order to qualify for an SBA loan for a startup. We can never base the loan 100% on projections, because even the best projections are just that. They're projections, and I've never had a client in my 20 years of doing this nail their projections exactly.